If you're one of the many people who have been auto-enrolled into a workplace pension, then you have probably been automatically placed into your pension provider's default fund. Most people rely on their pension provider's default fund to save for their retirement, and this video explains how a typical default pension fund works and what options are available to you. Default funds are provided for employees who do not want to make active choices about their pension investments, so funds are usually selected depending on criteria, including the average age of staff, their income levels, and assumptions about their risk profiles. Your money is invested in financial assets like shares, government and company bonds, property, and so on, in different proportions according to the level of risk being taken and the goals being pursued. Because default funds operate on a one-size-fits-all basis, they may not take into account your own needs or changes in market conditions. For example, people due to access their funds soon might want to be invested in a lower-risk fund. But the opposite might be true for someone in their 20s, where a higher-risk fund could lead to better longer-term returns. Default funds also may not give you the opportunity to invest in alternative funds, such as those supporting ethical companies or ones that are compliant with religious principles like Sharia. Ultimately, it is up to you to decide how you want your pension money to be invested. You can remain in the default fund, or you can research it and the other choices available to see if there are alternatives that better meet your own requirements. So how do you go about understanding what other funds might be more suitable for you? A good place to start is to consider the type of investments might be held in a typical default fund, and this graph shows how 4 types of asset classes performed between 2006 and 2017. Each has different risks associated with it and performs in a different way. Cash has the least risk of all the asset classes, but it also has the least return. The opposite to this is global equities, which are shares in companies around the world. These produce some of the highest returns, but also come with some of the highest risk. Government bonds are issued by national governments and generally pay periodic interest payments. Their capital value can also go down as well as up. The last asset class is UK property, and you can see how it's performed. These aren't the only asset classes available, but we've used them in this chart to show how they each perform in a different way. The funds that have performed best in the last few years are the ones that tend to have a higher exposure to global stock markets, whereas those that have underperformed are more likely to fare well in falling stock markets. But there are never any guarantees with investing, so many default pension funds are multi-asset, which enables risk to be spread as much as possible. And pension fund performance should always be measured over the longer term. If you want to know more about your default pension fund, the first stop is likely to be your employer's pension or HR department. They should be able to tell you more about the default fund to make sure its risk strategy matches what you plan to do with your savings in retirement. Workplace pension providers have to have an IGC Independence Governance Committee, which is tasked with oversight of the pension offering to make sure the provider offers good value for money. This means there are some protections in place, but you still need to take control of your own situation. If you need further help, talk to your employer about what help you can access from Beckett Financial Services. We've been helping corporate and private clients understand their pension options for over 30 years. To talk with a consultant, phone 01284 754 500 or email info@beckettinvest.com. Our website is www.beckettinvest.com, and you'll find our social media links there if you would prefer to connect with us in that way.